So in the last video segment, I talked about how the financial system has two main parts, financial intermediaries and financial markets. And now we're going to go ahead and talk about financial intermediaries. And the prime type of financial intermediary is a bank or other depository institutions. So this includes things like credit unions and savings and loans and so on and so forth. Kind of doesn't include investment banks as we would usually understand them. And of course what happens in a bank is that we have depositors, have savings, so they put their savings into the bank, and then the bank lends this money to borrowers. So remember, depositors are savers, and borrowers we're thinking about are people who are engaging in investments. Again, there is some sort of savings sometimes financing people's consumption borrowing, but from the point of view of society as a whole, what we're really interested in is the amount of real investment spending that happens, because that is going to help determine GDP growth. If I save money by consuming less, and then you borrow that money and you engage in that consumption, the net macroeconomic effect is not going to be real significant. We're just changing who has consumption any particular year. Okay, so a couple of things that banks do in this process here. One is they have expertise and specialization in making and administering loans. So in theory, you could go ahead and take your savings and go around town and try to find out who could borrow it or who wants to borrow it and try to figure out who was creditworthy or not. But that would be a lot of work. And if you have a whole group of people in a building who mainly collect deposits and make loans all day, they're going to be better at it. They're going to do it at a lower cost, and they're going to be better at determining who's creditworthy and who's not, and so on and so forth out there. So the bank serves a purpose in doing that. Another thing they do out there is, another important function, is that they engage in bundling small deposits to fund what are sometimes called lumpy investment projects. So we might have 300 depositors with $1,000 each. And we have a business that wants to engage in some $300,000 investment project. The bank can go ahead and roll all that money into one loan relatively efficiently. If you sort of think about what would have to happen otherwise, the investor would have to shop around town trying to gather a bunch of small loans from a bunch of different people, and that would be really cumbersome. The last thing that banks do, and this is really sort of crucial to a lot of problems that arise in finance, but also a lot of the benefits of having a financial sector, is what's called maturity transformation. And maturity transformation is the idea that depositors make liquid short-run loans to the bank. So you put your money in the checking account or the savings account, and you can get it back pretty much anytime you want. Even if you put it in something like a certificate of deposit, you can get the actual amount of money you put in back anytime you want. You just give up some of the interest that you otherwise would have earned if you withdraw it early. But banks make illiquid, long-term loans to, say, businesses or households. So in that previous example, we had those 300 people with $1,000 each in deposits, and they can pretty much pull their money anytime they want. The business that takes this $300,000 loan, if it is put in a situation where the bank can call that loan, can demand repayment anytime the bank wants, that's an extremely risky position for the business. And so this is callable by savers anytime, and this is not callable by the bank. There's some agreed schedule of repayment, and the bank can't usually force you to pay that back early. So what happens then if these people want their money back? If, say, 100 of those 300 want their money back, well, they come to the bank and they want $100,000, and the bank says, as in It's a Wonderful Life, I don't have your money. It's in Bill's house and Ted's house and so on and so forth. And so that creates a problem. So two things happen here. One is the bank might go, well, instead of just making the loan as soon as we have 300 depositors with $1,000 each, let's go ahead and wait here and let's not make the loan until we have 400 people. So we're not going to loan out all the money that's deposited. And that way, as long as not more than 100 people want their money back all at once, we're good. Now there's still some chance of being caught short for the bank, but when it has more deposits, significantly more deposits than it makes loans, it cuts down on that risk of being caught short. But it can't eliminate entirely. And so this is the issue of where bank runs and bank panics comes into view. And we'll cover the banking sector in more detail later and talk about these things more systematically here. But before we had banking regulation of any type, this was a really significant problem. And if you go back into the 1800s in the United States, before there really was something like a Federal Reserve and any kind of banking regulation or the Federal Deposit Insurance Corporation, there were relatively frequent bank runs and bank panics. And indeed, this was probably one of the things that made the Great Depression so bad, is that we had 3 separate waves of banking panics, which really disrupted the financial architecture of the country.